The broadcast is now starting. All attendees are in listen-only mode.
Good evening. Can anyone hear me? Good evening. Can anyone hear me? Can anyone hear me? Hey, Nick, can you hear me? What the heck? Okay, I'm going to go ahead and get started, folks. Please let me know if you can't hear me via chat. I don't hear anyone speaking. I don't think you're muted. Okay, I'm going to go ahead and get started. Good evening, and welcome to the Take Action Partners Discovery Call. My name is Dale Dix, and I will be your presenter over the next 30 minutes or so. Just a little bit about myself. I'm a retired Marine Corps officer, and following the Corps, I went on to retire from Fannie Mae, where I was in charge of diversity and inclusion training for approximately 5,000 employees for around 10 years. Post Marine Corps, I also became licensed in life insurance, mortgages, and real estate. And I've been a certified financial education instructor with the National Financial Educators Council since 2016. And I'm currently a managing director with United Financial Freedom. I've been with United Financial Freedom off and on since 2006. I first acquired the product that we're going to be discussing this evening back in 2006. But when the real estate market melted in 2008 and 9, I was so rattled that I lost my focus. Years passed before I came back to my wits, but thankfully, I was reminded of my passion for both our product and our company's mission, buying America back one family at a time. I've not paid off my first home with our product yet, but I'm back on track now, and I'm scheduled to pay off my current home in 2025. So without further ado, I want to thank you for joining us. The information that you're going to hear this evening can be life-changing if you take it seriously and don't procrastinate. We're going to talk about a solution to a huge problem, one that has caused people's health to decline, created marital crises and emotional distress, and a variety of other traumatic events in people's lives. And ladies and gentlemen, that problem is debt. I have a question for you. Have you ever thought about life in terms of who succeeds and who fails. It can be both fascinating and startling. The Social Security Administration years ago did a study where they tracked 100 people over the course of 40 years. What they discovered was very sobering. First, at the end of 40 years of work, 54 people were broke. They were dependent on Social Security, relatives, friends, and charities just to make it through the month. Another 36, unfortunately, were dead. They died before even completing the 40 years. They did not even get to enjoy the fruits of their labor. 5 needed to continue to work. 4 were financially secure. And only one out of 100 people was wealthy. So, what does that tell us? Well, the sobering reality is for every 100 people after working hard for 40 years, only 5% will be financially successful, while 95% will end up dead or dead broke. Unfortunately, debt has become the American way of life. And the root cause has to be that there's no financial education in our schools. We have little to no education in schools about finances, and yet finances are the foundation of everybody's household. Would you believe that only 21 states require one class on money in high school? And of those that do, they only scratch the surface with topics like balancing a checkbook. Do you think that's enough? What percentage of states do you think teach sex education or lacrosse or broadcast journalism in their schools? Almost 50 out of 50. Folks, you can't make this stuff up. It makes no sense. A saving grace, however, is that another study revealed that most of our kids think a personal finance course would benefit them the most. And there are some movements afoot, like ours here at United Financial Freedom, where we're on a crusade to turn this negative trend around. So there's no wonder that finances are a major cause of havoc in our society. It's the number one cause of divorce, and it's the number one cause of personal stress, which leads to physiological changes and issues in our body. So why isn't it taught in school? Do you think it's by chance? Or do you think it's intentional? Well, suffice it to say, the rich get richer while the poor get poorer. That said, we are committed to doing something about it and making a significant difference, and that's why we're here. In America today, debt is at an all-time high. This is true of both our national debt and our consumer debt. Our national debt is over $28 trillion, and our consumer debt is over $14 trillion. Now, consumer debt consists of things like mortgages, credit cards, student loans, and auto loans, and more. We have turned into a society where the American way of life is one where we buy things we don't need with money that we don't have to impress people that we don't like or know. The result, well, it's debt. Now, on a brighter note, if you are watching this webinar and are like most people, you probably want to get out of debt. You're not alone. The vast majority of Americans are drowning in debt, and yet they don't do anything about it because they don't know where to start. You, on the other hand, you are doing something about it. You showed up this evening, so congratulations. You see, debt is big business. The less we know about how to manage our debt, the more profit the big institutions make off of us. Although debt helps us pay for things that we want when we really don't have the money for it, debt also costs us our future if we don't understand the difference between good debt and bad debt, or if we don't know how to pay off that debt. So if it seems like no matter what you do, you can't make any real progress on your debt, well, it's because it was set up that way on purpose. And the only one who's going to save us is us. Even marketing has adjusted to accommodate and thus promote us being in debt. Just think about it. They no longer advertise how much something costs. Rather, they talk about how much the minimum payment is. And of course, they're counting on that. You making the minimum monthly payment and them making even more money off of you year after year after year. If you have done any research, you know that traditionally what we are told when we want to pay off debt is consolidate your debt for a lower monthly payment or go refinance to a lower interest rate. Those are two reasonable approaches, but the reality is that most people, when they do that refinance or consolidate that debt, they continue to pay the minimum monthly payment. So all they did was extend the problem and restart the clock on their debt. Maybe you learned about the bi-weekly program. If you don't know what a bi-weekly program is, well, it goes like this. Say you have a long-term monthly debt payment that you're making. You take that payment and you cut it in half, and you send that half payment to the creditor every 2 weeks. So you end up at the end of the year sending an extra month's payment for the year. That's great. The challenge is that most people think that when they are doing a bi-weekly payment, they're cutting the term of the loan in half. But that is just not correct. Mathematically, that is an impossibility. On average, the bi-weekly payment will shave off about 6 years on a 30-year mortgage. So instead of being paid off in 30 years, you'll be paid off in approximately 24 years. Now, that's a pretty fantastic result. At least you're doing something to get ahead of the bank schedule. You're doing something to pay down that debt. Now, if you listen to the financial gurus out there, and they do give some fairly good advice, and I think they really do want people to get out of debt. Now, one of the financial gurus says, reduce your standard of living, eat those ramen noodles, don't enjoy your life, save every penny you have. When you get an extra penny, use it to pay down that debt. The problem is the financial gurus cannot agree on which debt to tackle first. When you have extra money, one of the gurus says, send that money to the debt with the highest interest rate. Another one says, no, 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 that's not how you do it. Target the debt with the lowest balance. Once you get it paid off, roll it over and target the next debt with the lowest balance. That is called the snowball or the debt roll down method. So, you have competing financial gurus giving conflicting advice. How do you know what to do? How do you know what's right for you in your situation? The reality is there is one mathematical equation to find the fastest way to pay down the debt. That mathematical equation is at your fingertips. It is inside the Money Max account system. The Money Max account is not about refinancing. You don't refinance or do any type of debt consolidation or negotiation. None of that. There's no change to your standard of living, so you don't have to go out and invest in ramen noodles. It's not a bi-weekly payment. It's not a debt roll down plan. It's not a concept or theory. But what it is a web-based financial GPS. This system looks at money coming in and money going out. It looks at all the variables based on the timing of your monthly movements of household cash flow, as well as all the variables associated with your debt. It identifies that one mathematical solution for you to pay off your debt fastest. It then shows you step by step, turn by turn, exactly how to do just that. Become debt free in the shortest time possible. It is an individualized plan for your unique situation. No one size fits all cookie cutter solution. It will look at not only your current debt, but allow you to forecast and plan for any future debts like a new car or maybe a new roof for the house. The Money Max account has a proven 15-year history in helping our customers pay down well over $2 billion in principal. No more guessing. What should I do? Should I target the highest interest rate? Should I target the lowest balance? It takes all the guesswork out of it. It does it for you, not based on magic, but based on math. That is what a mathematical equation is all about. Your finances are math. The key is, are you sending the right amount to the right debt at the right time? Let's look at an amortization schedule. Specifically, let's take a close-up look at what is most likely your largest debt. If you're a homeowner, that would likely be your mortgage. Now, this particular amortization schedule is for a $300,000 mortgage at 4% interest with a monthly payment of $1,432.25. For illustrative purposes and to keep it simple, we will round down to the nearest dollar and just talk about a monthly payment of $1,432 paid over 30 years. This is the amortization schedule for that mortgage. Hold on a second, please. Here we go. Let's imagine it is your mortgage for purposes of this illustration. You will notice that at the end of year one, 69% of your payments went to interest. That's the interest that you paid in year one. Now remember, this mortgage has a 4% interest rate, right? Let's fast forward to year five. We see that over 63% of our payments went to interest. Fast forward again to year 10, we see that over 55% went to interest. And lastly, to year 15, where we see that over 46% of all payments went to interest. There's got to be a better way. And I'm happy to say that yes, there is a better way. So, how on earth are the banks able to claim that this mortgage has a 4% interest rate when so much of our payments are going to interest? Let's take a closer look at the actual breakdown of that payment. The monthly payment is $1,432. Of that first payment, $432 goes to principal, while $1,000 goes to interest. That means that 70% of your payments went to interest. That also means a 70% profit to the banks. But don't worry, you're on a roll in month two, as a whopping $2 more goes to principal. You have $434 going to principal and $998 going to interest. In year five, over $85,000 has been paid, but only $28,000 went to principal. That's over $57,000 that went to interest. That is double the amount that went to principal. Now, many people will refinance their mortgages between years 5 and 7. This means that they are resetting the mortgage back to the start and throwing away all the interest that they have already paid. Now, I have been a victim of this too. And even after I learned how compound interest works, I knew better, but I couldn't do better until I learned about the Money Max account. So you have an idea how long it takes to get one halfway through the mortgage. You'd think it would be 15 years, right? Since it's a 30-year mortgage. Nope. In this scenario, with a 4% interest rate, it takes 19 years and 3 months to make it to the one halfway mark. You have now paid off $330,000 in monthly payments, and your remaining balance is $149,966. You're only now at the one halfway mark. Remember, the original mortgage amount was $300,000. You're going to end up paying $515,000 over the life of the mortgage. That's $215,000 over and above the original mortgage. That represents 72% of the original mortgage that you're paying in interest, that you are handing over to the bank for the privilege of borrowing that $300,000. Now, while it may sound like not that it may sound like I am not for the banks, they play a pivotal role in our economy. But by the same token, I do think that the disparity between what they pay depositors for the use of their money, you do know that banks don't have any money of their own, right? And what they charge borrowers for the use of their depositors' money is obscene. We work hard for our money, and we deserve to keep more of our money in our pocket as opposed to handing it over to the bank. I'm just saying. So how can we accelerate this mortgage amortization schedule? Well, let's break it down. And let's say that you just got a new mortgage. It is a $300,000 mortgage at 4% interest, and you've not even made the first payment yet. See how it's broken down with $1,000 going to interest that first month and $432 going to principal? Let's play a game of what if. What if you can afford to pay all these principal amounts up front? If you add it all up, it totals $2,615. Now, I understand that most people don't have an extra $2,600 just laying around. I get that. And I promise you, I'm not creating money out of thin air. We are just playing a game of what if. Now, the way the amortization schedule works is anytime you pay the monthly principal amount in advance of when it is due, it automatically cancels the corresponding interest amount. That one-time investment of $2,615 just saved you $5,979 off the back end of that mortgage. That's a pretty good return on your investment. Would you agree? As a matter of fact, that's a 128% return on investment. Now, why don't we do this more often? Well, because most people simply don't have an extra $2,600 laying around. Now, our program does not create money out of thin air, so please don't worry yourself about that. But it is a powerful system, and we're going to review very quickly some of the strategies under the hood of that system, and hopefully you'll start to understand why it is so awesome. Our system is about making sure that every single penny, nickel, dime, quarter, or dollar that you make is either canceling interest or earning interest. Our program combines banking strategies with advanced math and innovative technologies to make sure that your money starts to bank like a bank. It's about turning around those rules of banking in your favor so that you can pay off that debt as quickly as possible and save as much money in interest as possible. Now, there are just 4 requirements to use our system. You need debt, and most people have that. That works out well. You also need a checking account. You need a savings account. And finally, the secret sauce. You need the Money Max Account program. Now, there's also the option of using a line of credit, whether a home equity line of credit, a personal line of credit, or a business line of credit. If you have one of these lines of credit and would like to use it instead of a checking and savings account, it is your prerogative to do so. That said, the advantage of doing so is negligible. And it probably would not make sense to establish one of these lines of credit just for this purpose, when you can just as well use an existing checking and savings account. Now, my understanding is that by using a line of credit, on average, it would only reduce the total payoff time by 2 to 3 months. At this point, I would like to interject that many of us attended the United Financial Freedom National Convention this past weekend, and we're still flying high. There were numerous announcements, the most formidable being our newest version of the Money Max account. We call it the MMA Pro. The MMA Pro entails the addition of a third engine to drive capability. The first two engines are there on the screen, the savings and checking and the advanced line of credit. The third and ultimate engine is the Wealth Builder account. Suffice it to say that the Wealth Builder account is a monster. It's a game changer. It's a revolutionary industry changer. And in my military vernacular, it's a force multiplier. And I'll leave it at that. Much, much more to come. I am still fired up about the news we got this past weekend. Let's take a closer look at how our system works. If we use checking and savings, and for your information, 70% of our clients, in fact, use checking and savings. Our system is based on a lot of different money saving strategies. We're only going to talk about 4 of them here, and they are interest accumulation, interest float, interest cancellation, and strategic payoff. Let's look at one possibility. Introducing John and Rebecca Jones, who have $5,000 of monthly household income, $4,800 of monthly expenses on average, and about $200 left over at the end of the month. We call this discretionary income. Of course, sometimes the expenses are more and sometimes they're less. We're going to target one debt right now, keeping things nice and simple. So we have one mortgage with a $200,000 balance and a 6% interest rate, and monthly payment is $1,199.10, and the term is 30 years. And since we want to practice a little bit of interest float, we're going to include a credit card with a 0 balance, a 12% interest rate, and a 20-year term. This part is optional. However, we want to show you how the interest float strategy can be used with our system. Now, in month number 1, John and Rebecca's paychecks come in totaling $5,000. Again, the system looks at money coming in and money going out. It is going to mathematically find the most efficient way to pay down the debt. The system says, you know what? Let's not have this money just sitting in your checking account. Let's move it over to your savings account. So John moves $5,000 from checking to savings, where it can start to accrue some interest. In the meantime, John and Rebecca are going to put everything and anything that they possibly can on that credit card. And they are going to practice what is called interest float. All $4,800 of their expenses are put on the credit card over the course of the month. That includes their mortgage payment, auto expenses, groceries, and utilities, and more. Now, we know that all bills can't be paid with a credit card, but this is for the purpose of illustrating the strategy. After making the monthly mortgage payment of $1,199, the mortgage balance decreases by a whopping $199, and their $5,000 of monthly income was able to set in their savings account all month and accrue interest. They earned $8 at 2% interest. It's not a lot, but it's an example of some interest accumulation. Now, in month 2, the $5,000 of household income is again deposited in checking. Now, let me ask you a question. If you start out with a credit card with a $0 balance and you put debt on that card over the course of the month, and then you pay that card off in full at the end of the month, how much interest was accrued? Well, the answer is 0. And that's called interest float. John and Rebecca Jones have allowed themselves to borrow money at 0% interest for 30 days, while their money was in their savings account accruing interest for 30 days. Now the system says, Let's go ahead and pay off that credit card in full. So they send $4,800 from their checking to the credit card, paying it off in full. Then the system says, hey, you are paying a lot of interest on that mortgage. Let's start paying it down. It tells them to move money from their savings over to their checking account, $3,789 to be exact. Now the system tells them to take $3,989 from their checking and make a principal only payment to their mortgage. They are now canceling interest on their mortgage. The one payment of $3,989 eliminates 16 payments. Let me catch up here. Saving $8,746. Folks, I don't know about you, but I'm getting so excited. I mean, that's a substantial amount of interest cancellation, and this is only month number 2. Now, you might be thinking, hold on, they still have to make a living. How do they live now that they have zero in their checking? Well, remember, they are still putting all of their monthly expenses on their credit card, and they will pay it off in full at the end of the next month before the payment is due. So all is cool. Now, in this scenario, we had a $199,000 balance at the beginning of month 2. After we made that additional payment of $3,989, the balance was reduced to $195,000 by the end of month 2. Check out our before and after. Before, we had 358 payments remaining after month 2. But after applying the Money Max account, we only have 342 payments remaining. We eliminated 16 payments by that one transfer of money. And originally, we were scheduled to pay $231,677 in interest over the life of the mortgage. Now we are set to pay just $212,931 in interest over the life of the mortgage. We just wiped out $18,746 in interest. You applied just $3,989 and you got back $18,746 in savings. That's a 369% return on investment. That is money that you will not have to pay the bank. It is canceled forever. Now let's look at a side-by-side comparison of a conventional bank program versus using the Money Max account system for paying off a $200,000 mortgage. In 1 year, based on the bank schedule, this person would have a balance of $197,000. However, using our program, their balance is down to $184,000. Following the bank schedule, it would take 5.5 years to come close to the same balance that our system achieved after just 1 year. And of course, the total repayment time, according to the bank schedule, is 30 years, while our program would have the loan paid off in just 10.4 years. And instead of paying over $231,000 in interest, according to the bank schedule, our system would have you paying only $70,000 in interest. That is a total interest savings of over $167,000. Can you imagine what you could do with an extra $167,000 in your bank account? Again, everybody's situation is different, but this side-by-side comparison is an example of how powerful our system can be when it comes to paying off debt and saving money that would have been spent on interest had they not been following the Money Max account system. I love the graph at the bottom of the slide. It clearly depicts the stark contrast between the bank's plan and the Money Max account. When you think about the fact that people are living longer these days, and most are more worried about outliving their money than dying. Imagine how life-changing it would be to be totally out of debt in the next 10 years, own your home outright, and free to redirect those monies previously earmarked for paying monthly debt to your future retirement savings. We're talking transformative. We're talking life-changing. Most people don't have just one debt, but rather they have multiple debts. And when you look at multiple debts, it's rather difficult to decide which debt I pay off first. Remember when we talked about the financial guru's advice? Even they do not agree on which debt to tackle first. We started with the mortgage at $200,000 and 6% interest. But what if you had a student loan at 7% and an auto loan at 7.25%? Maybe you bought furniture for that new house at 7.125%. And last but not least, don't forget about the credit card. Now, in this situation, which debt would you pay off and why? The more debt we have, folks, the more payoff options there are to choose from. How do you know you're choosing the right one? The term for what we are discussing here is strategic debt payoff. And the reality is that the wrong decision is going to cost you time and money. You might be wondering why you can't just make additional principal payments yourself. Well, it's far more complex than that. You see, according to FICO, the Fair Isaac Company, the average person has 13 active creditors. You heard me correctly, 13. That means that every single month there are over 6 billion different strategies, 6 billion different potential combinations of ways to pay off that debt. So, what is the likelihood that you will make the right decision every single time? As a matter of fact, it is highly unlikely. It is more likely that you will make the wrong decision most of the time. So why not eliminate that glaring inefficiency in exchange for peace of mind? Why not just use the Money Max account? It should come as no surprise, folks, that the powerful program like the Money Max account has been featured in a variety of nationally distributed magazines and on radio and TV shows. But in all likelihood, the best national recognition we could possibly have gotten was from Ernst & Young. Ernst & Young came knocking on our door back in 2008 and did some intensive due diligence. They are actually responsible for auditing publicly traded companies and doing what is right for the consumer. They are in charge of consumer oversight protection. So when they came to our doors, they wanted to investigate and ensure that our company is doing everything that we say we're doing. They went through our financials with a fine-tooth comb. They sat down with our executive team and they had their financial planners and accountants scour through our program. And after their extensive and intensive due diligence, not only did they find that we are a debt-free company that practices what we preach, they also found that our executive team is great and our customer service is exceptional. They further found that we are, in fact, doing what we say we are doing. We are consistently helping our customers pay off their loans in as little as one-third to one-half the scheduled time. And they were so impressed by us that they awarded us the Ernst & Young Entrepreneur of the Year Award, 2008, in the Utah Region Financial Services Division. Now, this is a similar award as was received by, you may recognize a few of these names: Apple, Starbucks, eBay, Microsoft, and many other companies that are nationally recognized for excellence. The true strength of our program is all about our financial GPS. Have you ever used a GPS in your car to get where you want to go? Isn't it like the ninth wonder of the world? I mean, it's right up there next to compound interest, isn't it? You see, most people have one. You just put in the address where you want to go, and the GPS gives you turn by turn directions on how to get there. Imagine having that type of technology for your finances. That's what we provide. You simply tell the system how much you owe for how long. What is your interest rate and what type of interest? Fixed, adjustable? Tell it about your income. How many? How often? How much? Is it commission based or not? What's coming down the road? Things like vacation or a new car purchase or some other major purchase. And when those unexpected expenses happen, which I call life, you simply tell the system and it will, you got it, recalculate. Now let's compare our financial navigation system to the GPS in your car. You see, just like the GPS in your car guides you to make all the turns, the MMA guides you to pay off all your debt. And just like the GPS in your car takes away the stress of deciding which route to take when obstacles happen, the MMA takes away the stress when complicated financial decisions come up. Your GPS in your car helps keep you focused. So does our MMA. It helps you stay focused on your financial plan, your roadmap to becoming debt free. The GPS in your car tracks your success as you follow the route. So does our system. It tracks your success as you follow the program. And lastly, just like your car's GPS gives you the time that you will arrive at your destination, our system tells you the date, month, and year that you will be totally out of debt, debt free, if you will. The Money Max account, folks, is math. It's all about the math. And here is some good news. The time it takes for you to update the system can be done in as little as 20 minutes per month. But I promise you, you might elect to spend more than 2 hours per month. I do, and I always consider it time well spent. Here at United Financial Freedom, we say the results speak for themselves. To date, we have helped our clients pay down well over $2 billion of principal. I didn't say interest savings, I said principal. The reality is, no matter what your financial goals, the only way you can achieve them is to eliminate debt. You see, debt is a blockade, a barricade, a hindrance to your financial future. It is critical to remove debt from the equation. Would you believe for the average person, 39 cents of every dollar earned goes to paying interest on debt? You heard that correctly. 39 cents for every dollar. Can you imagine getting a 39% raise? Folks, I'm talking no additional work. Without having to work harder, without working longer hours, just getting rid of the debt, the average person would realize a 39% increase in quality of life. I submit to you that that is huge. I'm asked all the time, will this system work for me? Well, the answer is I don't know, but it is time to find out. And the best thing you can do right now is get back with the United Financial Freedom agent who invited you and get your free savings report. If you were invited by email or Facebook, go back to that invite and get the contact information for your agent. The savings report will let you know the precise month and year you can become financially free using the Money Max account system. I want to congratulate you for taking the first step toward becoming debt free by attending this webinar. Well, folks, we have come to the end of our time together. As that concludes our presentation, it has been my profound pleasure to be your host this evening, and I'd like to leave you with this thought. The only difference between where you are and where you want to be is the steps that you haven't taken yet. Again, this has been Take Action Partners, urging you to take action now. Have an enjoyable rest of your evening. Good night.